young looking, but decades. And what they've learned is very interesting because Jeremiah and I talk quite a lot, is that in the fintech era, everybody likes to think it's about technology and it's all about putting people through processes and getting stuff out the back door in terms of scale. Actually, what this is really all about, a lot of this industry, particularly lending industry, is about relationships and what to do when things go wrong. And therefore, I thought it really interesting to get Jeremiah to talk a bit about their experiences from the asset-backed finance market. They've also increasingly do a lot more direct lending as well, and what that has to say for this industry moving forward. So, without any further ado, I'd like to welcome Jeremiah Silkowski from SQN up on the stage. Thank you, Jeremiah.
Thank you, David. He covered all my talking points, and I only have 10 minutes, so questions? No, thank you for having me here today. As David said, we do run the SQN Asset Finance Income Fund, which is a direct lender focused on asset-backed investing and equipment leasing specifically. We also run the SQN Secured Income Fund, which is focused on broader collateral packages, also invests through platforms, and is kind of that crossover vehicle for us for kind of into this fintech space and kind of the new era of banking. Let's see. There we go. Okay. There's nothing that I can tell anyone in this room about kind of fintech that they don't know better than I do. But what I can bring to the table is an experience that David's right does go back more than 25 years in the direct lending space. And what I'm seeing here is a number of corollaries to what we've seen in equipment leasing and how we managed through them, who were the survivors, where were the errors. Earlier today, I think somebody wisely referred to the ability to comment on kind of through cycle performance, that everyone has kind of clever answers, but it won't be really proven until you go through a cycle. I think that's a very wise statement. And I think a lot of these lenders will make it through the cycle. There's been a lot of lead up until a downturn. I think that's been something that the market on the whole has benefited from. You don't usually get this much of a run of kind of good business to build a proper infrastructure and to have kind of conversations like this about kind of what's the next phase. What are we looking to? A lot of times kind of new technologies, new products come to the market, and that window closes very quickly when you have to start addressing the problems before you had a chance to really start implementing the business plan. So, looking at kind of the fundamentals in direct lending and fintech in general, origination, and a lot of the platforms, a lot of the really successful groups have been phenomenal on the origination front. Underwriting, that's kind of another question that's out there. Kind of, is there a new kind of methodology to do that? And that also has to be proven out. Customer interface, this is something where I think fintech has really changed the game. And then it gets to the full cycle management, which I'll touch on kind of a little bit at the end, again, kind of keeping in mind I have 10 minutes and David's going to let me know when I get close to that. Origination, kind of the timing was perfect. Banks were giving lip service to SMEs, but not actually lending. They were lending, and when they were, it was essentially a personal loan to a business with a personal guarantee. Increased regulatory burden on traditional banks following kind of the last downturn in traditional banking. And the growing acceptance and expectation of internet-based solutions. Kind of this was the atmosphere in which fintech really kind of took off kind of where it is today. And I highlight this because we saw the same types of opportunities in my space about 20, 25 years ago. Underwriting. New models of underwriting need to be proven through full cycles in a down market. I noted this morning, somebody made, I think at least two people made a comment. I love this city. I'm a New Yorker. I'm from the United States. Very happy to have moved my family here recently. I think London is one of the most spectacular cities in the world. And one thing that always strikes me, and I'll tell anybody who will listen to me, is this city blends old and new better than any place else I've ever been to. And I think that is so appropriate for what we're doing here. We were looking at kind of the trends where things are moving with traditional banks. Kind of traditional banks are not looking at alt lenders any longer as competition, but a partner. And I love this picture because it shows, again, the seamless integration of old and new that this city does better than any place else. So we look at kind of where we are today, and this London being kind of the leading at the forefront of kind of really kind of defining what fintech is going to be. My theory is that where we're going right now will lead to a convergence of banking. Like alt finance won't be alternative. Traditional banking won't be traditional banking anywhere. There'll be a convergence, and I think that's going to be driven by probably mostly compliance, but mostly the expectation that kind of alt finance has given to the customer that they can't be abused by the banks any longer. I didn't know if this slide was going to work, and I don't know if it still did. It's kind of hard to see. I think when we talk about customer interface, I put this kind of tearing the book up photo because that's in fact what's happened. It is a timing thing again. When banks routinely, aside from cable companies, were regularly rated as the most customer-hated institutions out there, fintech came in with an online, easy, competitive platform that was eager for your business. Again, this is very consistent with what I've seen in the equipment space. Then we get to where it really matters, right? Right now, being volume focused is important, but if it's also dangerous to be solely committed to kind of volume. So what do you need? Kind of seasoning test not only underwriting, but infrastructure and business plans. Like I said before, it's very unique that we've had a longer run-up than I think most new products in the market do. And I think this gives a lot of people time to spend time thinking about it. Where do you need to be focused? Again, nothing that I'm telling this room that they don't already know, that everyone's talking about. It's been kind of digested. It has been reconsidered. It has been debated in forums like this. Workout and recovery plans. This is particularly an interesting segment when you're talking about having investor capital, because you go out there, you talk about kind of your model, your underwriting, your ability to generate returns, but no matter how transparent you want to be, investors don't like to hear that there's going to be workouts. You look at kind of loss rates and historical performance. You need to be focused, and you almost have to force that conversation with investors. Looking about loan replacement, another thing that we have experienced in the past is when you're balancing, your origination and your workouts, along with your ability to take that asset offline to put a new asset in. That's going to be particularly difficult with all the competition in the market, where rates tend to decrease daily. Customer retention, that's something that this segment is particularly focused on. I heard a lot of good ideas and actually just got good reports of progress today alone. And innovation, right? This industry is defined by innovation. And the minute it stops innovating, it becomes the next new traditional lender. And again, all of this is ever more complicated by kind of the increasing regulatory burden placed on institutions. So there are a number of questions that fintech lenders should be and direct lenders should be asking themselves. I don't have enough time to go into these. Again, it seems like something that's being considered across the board. What does the impairment policy look like? Do you have transparency, especially if you're financing through platforms? There's a couple high-profile cases right now where very legitimate managers were taking in kind of loans from platforms and didn't have the transparency they expected from those platforms. Should you have a workout group? Traditional banks have workout groups. Is that a successful approach? What kind of message does it send when you hand that over? Is there an assignment, an alignment, an incentive to get the right results there, or are they just trying to get it off the books? Should lawyers be driving the process? And what are the costs? How do you manage that? What are your expectations of timing? And more important, what are your investors' expectations of timing? We found that that's one of the hardest things to manage. Should you roll up and sell your paper, kind of take a piece of the book and send it away so you can focus on what you do on the origination and the customer interface sides? And this all in light of kind of IFRS 9, forcing us all to behave kind of more like banks under a set of rules that don't make sense for even the banks. So what have we learned? From my specific business, I've been in equipment leasing, fund management since 1991. So we sit here in 18. It's been a while. In the 80s and 90s, there was kind of a move towards new entrants into the market because banks were the traditional equipment lessors. We had a lot of business that we were doing because people were frustrated with banks. They were opaque. There was a standard that they would lend, just like they do today, as a consumer loan into a business. That set up an opportunity for independent equipment leasing funds like ours to come into the market. Our structures were improved over what banks were offering at the time. That sounds familiar as well. We used new underwriting. We didn't use kind of the traditional kind of paper-heavy kind of approach to looking at kind of equity and mortgages and things like that. There was a new way to look at equipment where equipment itself was the value as opposed to kind of the underlying credit of the borrower. And all in all, we provided a better experience to customers. That is what kind of led to the growth of a large number of independent equipment leasing funds investing on behalf of retail and institutional investors. I think it's a perfect correlation to what we're doing and seeing here today. So what's happened? The high volume of new business generated at that time led to greater access to the capital markets and the securitization markets. That drove down the cost of capital for more new entrants, which put more pressure on the guys who were maintaining a more standard or more robust underwriting approach. As portfolios matures, delinquency rates hit more than 4 times historical averages. That was an unprecedented event, and it happened very quickly, unlike kind of this market where we've had a little bit more time in between that. That was a shock, and when things like that happen, capital gets pulled away very quickly, and like a house of cards, the rest of the infrastructure falls apart. Banks and insurance companies, who were secondary market participants through the securitization market, suffered losses. What you have to remember is banks and insurance companies are the ones who influence regulators. If they're against your asset class, they're going to make it difficult for you. I think that kind of we've passed that kind of that crucial point here where we have a convergence, but it was a realistic effect of what happened in the equipment leasing space, where you had now a stigma on an asset class that fell apart relatively quickly, driven by the influencers of the regulators to make it even harder. What was interesting was there were very few successful roll-up opportunities. And the reason there was is because each model was bespoke. There wasn't a standard underwriting process. There wasn't standard documentation. And the assets were diverse. And so we see that we talk about all these different ways to approach the market and provide financing. We have to be cognizant that there isn't a very clean, easy solution to roll this up. And where does that go? Borrowers and lenders kind of went bankrupt and out of business. Lenders and the borrowers, both. I tried to count, and I tried to look this up to give you a sense of how far in the past this was. The internet seems to go back to 2000 for securitization data in the equipment space. And at the end of the day, this had left a stigma on the industry for a number of years. I would say kind of 12, 15 years. There's still kind of an impression that equipment leasing and asset finance of this nature is somewhat risky. And it was fully driven by the large number of new entrants, not focused on what happened in the workout space. So who survived? What worked? Underwriting those at the end of the day, those who survived had the following traits. Underwriting policies focused on realistic, tangible downside protection and security packages. All right, there's a better way to get the data. There isn't a better way yet to assess the collateral, though. Limited leverage and historically more appropriately delinquency levels. Everybody suffered higher than expected delinquencies, but you have to always be aware of the leverage. Strong relationships with investors and banks, born of trust and transparency. The guys who went out to their lenders, went out to their investors, said, I need time, we're going to work through this, we'll be there. Those are the guys who survived, not the guys who sold their paper and tried to roll it up and move on to the next set of origination at different standards. A demonstrated long-term commitment to work through defaults rather than walk away. I kind of mentioned that already. Managers willing to make sacrifices, reduce fees, no fees, buying back portions of the portfolio, kind of being there when kind of the phone rang for the angry people on the other side. And ultimately, it was models that did not rely on origination fees to do new business. And I think that's an incredibly important part of the lesson here. So while I can't speak of the specific infrastructure today of the direct lending space and in AltFi, I can say that we have a corollary that's very close, kind of on very quick bullet points, is very relevant to what we're seeing today. But again, I can't emphasize enough that I feel like this particular segment of the industry has had a hell of a lead time and enough profitability to build a strong infrastructure that can prevent this from happening again. Thank you.
Jeremiah, two quick questions. One, do you think that you can transform underwriting and risk measurement by using new data, big data, or is effectively there is no way to rewrite the underwriting rules, that they are sort of pretty constant, and they don't really change if you're given more data?
I cannot say that somebody won't find a better way, because it's very possible. But what is the benefit here is the information. It's always the more information you have, the more relevant information you have, the integrity of the information you have. Do you have real data? That's the question. With real data, I think you still apply the same underwriting process. It's just the quality of the data that is really the advantage to the AltFi industry.
And second question, you talked about a quantum of increase of about 4 times.
Yeah.
So a lot of the industry, for instance, say is focused on consumer lending or SME lending, doesn't really make a difference, one of those two. And then they point to traditional default rates in consumer lending. It's been out there for a long time. You know, all the big index firms have got measures of consumer lending and their default rates. And then people say, well, it will probably go up by as much as the traditional consumer lenders have seen their default rates go up if there's a recession. But your data suggests that actually, because so much money comes into the industry, and standards sometimes get a bit too lax, that the default rates could actually be even bigger than historical average. Do you think that's possible?
Well, that's our experience. It is because you're making market, right? You're looking at a data set that was specifically lendable and predictable, right? What you're doing is providing access, what we talked about today, to segments of the market that wouldn't have been part of that data set before. So I think absolutely, if you're expanding the market with a different type of approach, if you're bringing in new entrants or new participants on the borrowing side that weren't part of the pool before by some other rationale, you can't apply the same statistics to them that would have been consistent with 20 years or 30 years of data.
And one very last question. You talked about the cycle that you went through in the asset finance industry, and it went through a cycle, and you came out the other side of it, and yet you still managed to raise, whatever, a few $100 million from the city. So the city must have known that the industry's gone through everything that you've talked about. What's the one single factor, do you think, that made them think, well, okay, actually, we'll forget all of that, we'll put some money in you?
Quite frankly, it could have been in the London markets rather than the U.S. markets. I could not have raised that capital in the U.S. market because the stigma is still too strong over there. This market, we also came with a 12-year track record, a full cycle track record that spent a lot of time talking about the workouts and what happens in the downside protection. That was the most compelling thing, is telling that story.
Very interesting. Okay, we're tough for time, but say thank you very much to Jeremiah. Thank you.